So we're looking at the links to recordings and slide decks of previous guests. There's the recordings and the slide decks that are there. So just to point you at a few of them, back in November, we had a couple of talks on self-directed retirement accounts from Chris Tanner and Scott Martyr. David LaPlante came in. He talked about hyperlocal real estate. So he had a website that lets you do analysis for medium home values, the medium income, crime rates, various things that you want to know that can be hyperlocal to a particular market that you might be looking to invest in. Then we had Tim Hubbard in particular. He came in and talked about Airbnb and short-term rentals. So if you're interested in this topic, we did have a talk on it. Eric Tate came and talked about alternative assets. So he's invested in everything from vineyards to coffee plants in Colombia to various other types of alternative assets. Then I jumped in on March 6th when our guest speaker canceled on us and spoke about real estate syndication, and I did a part 2 the next week. Stu Kerber here talked about farmland within the Columbia River Valley. And then Kathy Fetke talked about a macroeconomic view of what was going on, particularly in light of the Fed and recent Fed announcements. It looks like I still need to get up the most recent presentation, which will be down here at the bottom. But I just wanted to make everyone aware that we do have links and recordings to all of our previous speakers here, and we'll start listing them here in this table. I'm also looking at maybe a more friendly way of organizing this data so we can sort by categories or by speaker. So stay tuned for a little more thorough treatment of this data as it starts to grow. All right. Before we go to our speaker, do we have any questions or opens? And then I'm going to introduce who our next couple of speakers will be over the next couple of weeks, and then we can go into Kent's presentation. All right. I also wanted to note that the Real Estate Investment Club has been sponsored by the NextGen Professionals Network here at Intel. And so we're now officially part of their organization. And being part of that organization, we have been enjoyed, kind of being under the umbrella in terms of getting help with getting our outside speakers through HR and going through all the proper channels in order to make sure that they're approved to speak at Intel to Intel employees. We also want to say that all of the views that are here are not reflective of Intel's views. Of course, they're the views of the people that are speaking and of the club members. So upcoming, we have Kent Ritter. He's today. He's going to be speaking about creating apartment communities, as well as he does have some single-family home rehab experience. And he also has some apartment community experience where his particular group has been doing a fairly novel way of renovating an apartment building. That is, they do their entire renovation on the unit in 8 hours. So the tenant goes to work in the morning, they come back and they have an entirely renovated apartment. And so he's gonna talk to us about a couple of those different topics. And then next week we have Amanda Hahn. She is the author of a number of real estate tax books. So if you're interested, and she herself is a CPA who works specifically with people who are looking to maximize their tax advantages through real estate. So that was a topic that people had expressed interest in, and we went out and found someone who could talk on that. And then next, I'm really proud of this. Courtney Buck is a real estate investor who works at the CDC. And he's going to come and give some special insight into just his own personal opinions about the real estate market and how COVID-19 is affecting the real estate market. And in between here, we're going to try and schedule a few more people that are going to talk about Airbnb and rental rehabbing. If you have other topics that you want to see scheduled for next month, please let us know. And lastly here, we have Whitney Su. Whitney Su is the host of probably the most popular real estate syndication podcast. And he has over 500 interviews up at his site. It's the Real Estate Syndication Show. And so we'll be hearing from him on February 29th. So before we go over to Kent Ritter, does anybody have any opens, or does anybody have any topics that they want us to find a speaker for? All right. Then we'll turn it over to Kent. Are you online, Kent? I see you're a guest here. I'm going to promote you to make you an attendee. I think that will allow you to share your desktop. And you're on mute. Yeah, we can't hear you. I see you're starting to IM in the conversation. We can't hear you right now. Somebody mentioned a question. Just curious why there are so many guests on this call. Isn't this just for Intel employees? Yes, absolutely. Intel HR requires that this is only made available to Intel employees. And we actually ask you, even though we're making the recordings available to Intel employees, please don't distribute them outside of Intel. Intel HR does have us focus only on Intel employees. And of course, the guest speaker is brought through a HR process. There's a form we have to fill out, and we have to go through a process in order to get them approved to come in and speak. Okay. Kent, are you there? While Kent is trying to get his audio working, does anybody have any topics they want to talk about?
Hey, Daniel, this is Ryan. I'm going to be talking to somebody about vacation real estate next week that may turn into a decent topic. I don't know. I'll connect with you after I talk with them. But
yeah, great. If you have people that you can bring in that might make good speakers, definitely.
Well, I'll let you know, and you can bet them. But there's a guy I actually went to high school with that started this whole company that's doing this now. So I'm like, oh, that's kind of fun. So I'll find out more about it.
And actually, we do have a small committee now that is going to be vetting these people. We've had 3 or 4 people volunteer to be on the committee to vet the guest speakers, including Pin Yinning and a few others. And so it'll be a group effort to do that.
Excellent.
So Kent is saying that Skype says that he's on and he's speaking, but I don't hear him. Kent, can you call in through just a phone? I think you sent me your...
His audio just went unmuted.
Where is he? I don't see him in the chat anymore. Is he there?
Yeah, he's still showing in there as participant or as a presenter.
Well, apologies for this. We're going to get Kent on the line. While we're doing that, I guess one of the things that I could note is that at least in the apartment world, March was going to be kind of a test month for how well rental collections were going to do. And there have been several large reports out from CBRE and from Yardi and from others that are saying that at least March collections are very much on track. And so we're not beginning to see the downturns yet within the real estate sector from COVID-19. In my own properties that I have, we're seeing a 97% rental collection at this point. So it looks to be good there, and we're keeping our eye on April at this point. So good news in the real estate sector in that it hasn't been hit yet. However, No one knows the future, and this all depends on how long this economic condition lasts. So that's a little bit of news, at least from my side. Kent, are you there?
I have a question while
Yes.
Ken joins. So I read in the news articles saying that now there are tenant protection laws and stuff, right? So because of COVID-19, if the tenant is unable to pay their rent, now the landlord cannot penalize them or collect any late fees or anything, or even eviction kind of things, right?
Yes.
So is there data on what are the things which are there to protect the landlords, in addition to tenants?
So, unfortunately, just like the tenant provisions with the landlords, it also depends on which area of the country you're in. So, for instance, there are some parts of the country that are very proactive in protecting tenants. California, for instance, has had a moratorium at least for 90 days and even longer. A tenant eviction in California takes upwards of 9 months anyways. So there are definitely areas that do that. In one of the ways that they're enforced is that the lenders right now, if the landlord is having hardship due to being not able to collect rents, there are different types of programs that Fannie Mae and Freddie Mac are offering right now to delay the payment of the mortgage payments. And in order to take advantage of those programs, the landlords have to agree to a lot of different provisions. One of them is the inability to evict people during the time. And so that's called landlord forbearance. And Fannie Mae and Freddie Mac does have quite a bit of information in and about on how you can take advantage of the programs they're putting out right now. Mostly what it is that if tenants are having difficulty paying, then of course the landlords need to be flexible and to work with them. And then of course, as you go up the lending chain, the landlords need to go and talk to the people that they're getting their loans from. And so lending requirements have tightened considerably here. I see Kent Ritter is in twice. I'm taking you from guest and making you an attendee, Kent. So hopefully this will fix your problem. And you look like you're unmuted. Make a presenter. I'm going to make you a presenter. Can you share your screen now, Kent? But in terms of the programs that are available for landlords, it all depends really on who your lender is and being able to work with your lender.
Yep, thank you.
A lot of the bridge loan lenders, they've stopped making loans or changed their terms significantly. Fannie Mae actually has changed their requirements in terms of their loan-to-value ratios. So instead of loaning at 75% loan-to-value, now they tend to be loaning around 65% loan-to-value, which can change the financials of the deal quite a bit. Kent. Go ahead.
Can I ask a question?
Yeah, absolutely.
This is the relevant question about this, landlord issue. So, some landlords, are being affected by some tenants taking the advantage of this no eviction thing, and they are not paying rent because they know that there would not be eviction, and probably they're using that money towards their next apartment, so that they can get out and then use that towards the security deposit and not pay the rent. So, what kind of I don't see any kind of benefit that government is giving for landlord not being able to evict people who are not able to pay. And also some people cannot even pay at all, right? So small businesses are being, bailed out or, being given some kind of like benefits of like payment protection and stuff like that. But how about landlords? Do you know anything that the, government has any benefit for the landlords?
Yeah, unfortunately, the CARES Act did not have significant provision for landlords, and so that has been one of the biggest areas. There haven't been a lot of provisions for landlords. That's why landlords need to be sure when they're doing their deals that they have provisions for a rainy day. So my answer to that is that there are small business administration loans that people have started applying for and taking advantage of. As far as I know, those aren't being paid out yet. But the majority of the protections haven't been for the landlords. So in that respect, you need to negotiate with your lender. You might be able to get forbearance in terms of not having to pay for a little while, but you're also going to have to agree to a variety of stipulations in order to do that.
I have one question. What's the easy way to, let's say the tenant doesn't pay the rent for 3 months and switches to another rental property? What's the easy way to help get back that 3 months of lost rent?
Right now, there's not a lot of easy ways unless you want to take the tenant to court.
That's what I said, right? I mean, I cannot go there, and I mean, basically that his question is my question too, right? And I did not see any kind of benefit for me that I will get rent, that kind of lost rent from the government or state. So I will be losing that money either way.
Yep. Yeah. And one of the things that one of the best things you can do is just make sure that you've got an open door policy and that you can talk through the situation with your renters. But unfortunately, the reality of the situation is there are going to be people that take advantage of the current situation.
Hey Daniel, this is Harrison. So I've got some rentals, and I've talked to every one of my renters and figured out what their situation was, and I even reduced the rent a little bit just so that they would help them out a little bit. So the goal is to keep them in there, because the last thing you want is an empty property at this point in time. Mm-hmm. And you're right, you might take a hit, but that's the upside and downside of this. Just like any other investment, like the market, when you lose 30% of the market, what do? Well, no one's going to bail you out on that. So this is just the upside downside risks of real estate, right? And I would agree that you can just take them to court after the moratoriums are over. If they still owe you money, then you take them to court, and there will be a hit on their kind of credit record if you have the reporting services tied to your rent collection service. So there's a couple options you can take to try to reclaim that money back, and if there's a judgment against them, then they're going to have a lot harder time getting the next apartment potentially.
So Harrison's question is that when the moratorium is over, how would you know their new address? Because to get to a court, you have to know the new address. You have to serve them. There are some procedures. How would you know that?
There are private investigators. There are services that track that. There are, things like that. Not easy. I'm not saying it's easy, but there's mechanisms.
Okay.
I just put the bridge number inside the chat window. Can somebody check to make sure that this bridge number is working? Meetup.com or meetup.intel.com doesn't put out a phone number usually. It sends out a Skype call. And so I'm trying to get this phone number to Kent and make sure that it works. Somebody have a question?
I just want to add one more thing. There is a forbearance benefit, right? But most of these banks are saying once the 90-day is over, you got to do a catch-up rent in lump sum. So it's not like your 30-year mortgage get extended to 30 years and 3 months. You still got to start paying from the 4th month, and you catch up for those 3 months of mortgage.
What you should do is refinance before the forbearance amount is due. So go refinance it, and then that new loan pays off the old loan, and that part that's forbeared gets spread over 30 years or whatever your terms are.
I see.
But refinance has a cost, right?
Sure, it does. Absolutely.
I think it's also important to be proactive with your communication to your renters.
Hey, Daniel, it's Kent. Can you hear me?
We can hear you. So let me finish that thought really quickly.
Go for it.
We sent out a notice to everybody who's in our apartment complexes saying that, the rent is due and that we have an open door if you need to discuss any situations that may arise. But we level set and set the expectation up front that rent is still due. And even if there are situations where, there's hardships, of course we want to work with those people because we don't want to see anyone get, thrown out of their house or lose the place they live. So, in those particular situations, we work out, one-on-one deals with them, and initially we weren't sure if it was a good thing that we weren't hearing from a lot of people or if it was a bad thing. It's hard to tell, but at least right now our collections are at 97%, and so we're doing fairly well at least this month, and we'll see what happens next month. But we should also set the expectation with the renters that, even if there is a delay in rent, that it's not that they live there free. They need to do a catch-up at some point, and we need to figure that out. So just like the landlord catches up with the mortgage lender, the renter needs to catch up with the landlord as well. All right.
Appreciate it.
Kent, you're here. Do you need me to share your presentation for you?
Yes, I think I'm going to. I was in the invite or in the meeting a couple of times, and for whatever reason, none of the functionality is really working for me. So yeah, if you could share, that'd be great. And then just let me know when you're sharing, and I'll just tell you when to hit next slide.
Okay, I am grabbing your presentation right now, and I'll have it in just a moment. And I see you give me a link to the video also, so I'll make sure that is ready for you as well.
Yeah, it's embedded in the slide. I just included a link in case. I know you had said there have been problems. So if you need to go straight to YouTube, you can do that with the link.
Okay. All right, and I'm going to share my screen.
All right, well
go ahead, Kent.
Thanks, everybody. Sorry for technical difficulties. Go for it. You ready for me?
Yeah, just go ahead and start talking, and I will have it up in 10 seconds.
Sure, yeah, no, I'll just start giving an overview. So, yeah, again, apologize, guys. Glad we can be here. Hope I can provide some value to you today. So the first slide you'll see, I've included a few pictures and just a little bit about myself to give you guys some context around who I am. I know Daniel, I think, already gave you a little bit, but so I am a husband and father of three. First and foremost, I've got 3 under 4. It's likely in the at-home scenario that we live in today, you'll probably hear some of those kids running around outside my office. I am a former startup leader and management consultant. So I spent 12 years of my life as a management consultant working with large businesses to help them solve their financial problems. I left with a few partners, started my own firm, and we ran that for about 5 years. At the end of 2015, sold that business, and that's really what started my real estate career. Really looking at the way, one, what was my next adventure, and then two, now that I had some capital, I wanted to understand, where's the best place to put it. And I knew I didn't want all my eggs in one basket in the stock market, so I looked at real estate. I'd always been interested and decided to, jump in full steam. And really since into 2015, that's been a large part of my focus. So I started my career in real estate really as a passive investor. So investing in 10 passive multifamily deals, really leveraging that as my education to really understand what real estate was all about, what putting deals together was all about, how you manage deals. So I really saw it as kind of my foray into getting started. I had a vision of always wanting to be active, but I recognized that I didn't know what I didn't know. I didn't know a lot of things, and I needed to educate myself first. Along the way, so my primary focus is on multifamily apartments, and now I'm an active syndicator, so I moved from the passive to the active side. But along the way, I also picked up a residential business with a couple of friends of mine, and we focus on fix and flips, long-term residential rentals, and Airbnb. And we've got a portfolio of 12 properties in Indianapolis, which is where I live. And we've got 12 long-term rentals, a couple of those are duplexes. We've got an Airbnb, and we've got 2 flips going on right now. The pictures that I included, the house with the horizontal fence in the front, that's a flip that we completed last year. Had a lot of success on that one. And then the 2 buildings below are 2 apartments that I own through my syndication business that we purchased last year. And finally, I've just recently taken a role with a company called Burge and Held, which I'll speak about a little bit more today as the Vice President of Investor Success. It's really a fancy title, meaning that I'm focusing on marketing, investor relations, and capital raising. And with that, we can go to the next slide, Daniel, which will tell you guys a little bit about my primary focus. And I guess just to take a step back as we go through this, it's a fairly short presentation. It's really 10 slides, but I'm pretty laid back and very conversational. I'd love it if you guys would engage and ask questions if you have them. Don't feel like you have to wait until the end. So I'm happy to, if you're enjoying the content that I'm reviewing, happy to go through that, and it won't be too long anyway. Then really happy to get to questions and answer anything you had. I saw some great questions, heard them earlier on COVID-19, how we're kind of managing through the process. So if you want any insights from a large operator, happy to do that. So back into the presentation. So Burge and Held is we're a large operator with about 11,000 units, 1.1 billion, just over that now in assets under management. Been operating since 2012, where the 2 principals really they were actually in development they're in development, and we've been active since 2008. In 2008, they saw really development drying up and saw the opportunity to switch into value add, which now is what we focus on. So for the past 12 years, focusing on value add opportunities, primarily Class B, and we look for strong markets. So it's market first and then deal. So we like cities like Indianapolis, which is where we're based, because Indianapolis is it's the hub for government in Indiana. So a lot of government jobs. It's got 3 major universities, so a lot of education jobs, and it's got 8 or so major hospitals, and a major payer in Aetna is headquartered here. So you talk about jobs, we like things that are non-cyclical, so healthcare, education, and government. So we like cities like Indianapolis, cities like Columbus, Ohio, Minneapolis, Kansas City. Those are areas we target. So as you can tell, we're primarily Midwest focused. We've expanded lines of business from that Class B value add, which is our bread and butter, into an affordable housing line of business, which I'll talk about in a little bit, as Daniel talked about, creating communities around that. And then we've actually gone back into new development lately as we've seen opportunities there start to make sense again as prices come into line with what it would take to buy a property and then fix it up. At a certain point, the math just makes sense to might as well buy or build new. Over our history, we raised about $300 million in equity, and from a deal, what deals look like. So we're typically investing 10 to 20% alongside the investors in each deal, and typical structure be a 7 to 8% preferred return, meaning that we're giving the investors 7 to 8% before the sponsors are taking any money out of the deal, and after that, it's typically a 70-30 split of profits, 70% going to investors, 30% going to the sponsors. So just a quick overview to give you some context of what I'm talking about. So, large operator, we're in 8 states, 11,000 units, and quite a big track record as we've gone through that. So as we move to you can just go ahead and go to slide 4, Daniel. Wanted to just provide you guys a little more context of why I like real estate and why we like real estate. Looking at what this graph is a comparison of our real estate portfolio and how it's compared from a return standpoint to things you're used to seeing, such as the S&P 500 and a couple of REIT indexes, so that you can look at the difference in performance. And I mean, the things that we like are steady performance. We're focused mainly in the Midwest. We like the Midwest because the Midwest has more yield than other regions of the country, just from a return standpoint, but it also has stability. We don't see those cyclical ups and downs that you may see on the coasts, for example. We tell people pretty consistently, we're not here to hit home runs. We're trying to hit singles and doubles, but we're staying on base. And in doing that, we provide fairly consistent returns. And we've been able to do that over about 19 deals that we've taken full cycle at this point. But don't want to spend too much time there. Just wanted to give you context as we talk about the rest. So slide 5, one of the things that really differentiates and I think is really important as you look at investing is for us, we're completely vertically integrated, meaning that we have in-house property management and in-house construction management. So we're not hiring third-party property managers. We're not hiring third-party construction. And I think that allows us to do some things that are really cool, which we'll talk about later, such as Daniel alluded to, which is our 8-hour rehab process. And it allows us to do some of the things that we do that are a little non-traditional from the amenities and things we offer our residents as we create communities around the properties. So it's really that the ability to have control over the entire process is what allows us, I think, to outperform in many ways and also provide some unique value to our residents. So slide 6 is a picture of one of the community gardens at our properties. And I love this picture because I think it tells such a good story. One of the ways that we really seek to differentiate, as Daniel alluded to earlier, is to create communities around our properties. And especially in our affordable housing line, our affordable apartments, we've created what we call a resident empowerment program. And it's really made up of 4 pillars. The first is healthy food. So things such as community gardens. We also partner with nonprofits in the different communities to bring in subsidized farmers markets to the properties, so folks have the opportunity to shop for healthy fruit and vegetables. Many of these places are located in what would be considered a food desert, so this can be one of the only sources for these folks to have really healthy options. So we've seen these community gardens especially develop into a fantastic sense of community and a sense of pride and ownership, which is pretty amazing. The other pillars are a language assistance program for folks that speak English as a second language. The third is a financial assistance program, really a financial literacy program, teaching people things about budgeting and taxes, and et cetera, just helping them more successfully budget and plan through their lives. And then the fourth is a BH Kids program, which is focused on helping underprivileged children make it through, making it really all the way through education and through high school. So, we're subsidizing, we're buying backpacks and supplies and goods for them and really trying to help kids get to that process. So there's 4 parts to our resident empowerment program, which, I think it's great because we always want to be improving the communities and we always want to be doing good. But there's also just a very practical outcome of doing this. And what we've seen on our properties, because we're able to provide these intangible amenities to these folks, because these are properties where just economically, it doesn't make sense to provide a lot of the amenities that you can on a Class A property, for example, right? Like big fancy pools and things of that nature. But what we can provide are intangible amenities that these residents really need. And in doing that, we create a sense of community, a sense of ownership. And what we've seen is turnover drastically decrease. We've seen bad debt decrease. People want to stay and they want to stay. They feel ownership, so they're not, they're not messing up the properties. And so we've really seen a positive impact on our properties overall. We've seen the length of time that people stay on the properties increase. And so I think it's really been a win-win. And it's something that we're continuing to roll out. We've got it going in 11 properties at this point and continuing to roll out throughout the portfolio. So we're really excited about that. Let me take a moment and stop and just see if there's any questions. No, I'll keep rolling. So on slide 7 is another example of a way that we're trying to differentiate. This is, we say we're trying to maximize our social impact. We're trying to minimize our environmental impact. So another thing that we've undergone is we've done these LED light initiatives at our properties. These are 2 case studies from 2 of our properties, a 340 unit, or excuse me, it's a 250 unit and then a 200 unit. But you can see how much they've saved from a carbon standpoint just by putting LED lights throughout the properties. And that also increases the safety on the properties because LED lights have a much wider spread than traditional lighting. So the properties are much better lit. But again, just something that we're trying to do to differentiate and to have a positive impact on the environment, but also have a positive impact on the bottom line for our investors as we're reducing utility costs. And if you go to 8, this is a case study of one of our larger properties, a 740 unit property. And you can see the before and after pictures. And what's really incredible is we were able to complete an entire renovation of this property, including the exteriors. So all 740 units in a single year. On a normal schedule, that'd be a 3-year project. And the way that we were able to do that is because of our 8-hour rapid rehab that we've developed. And I'll save a lot of it to let the video speak for itself. I've got like a 2-minute video I want to show you guys, but it's a time lapse of it. But a couple of things to call out. One, so typically when you take a unit down, it would take 2 to 3 weeks to renovate that unit and get that unit back up so it can be producing revenue. So that 2 to 3 weeks is lost revenue. We were able to, through this entire process, maintain an occupancy of 94% because we had no downtime in our units because the tenant would literally leave in the morning and come home at night to a brand new apartment in the 8-hour process. So because of that, we were able to accelerate the returns back to the investors and really compress the time getting through that renovation period, which is extremely disruptive for the residents. As they're dealing with construction for 3 years, we're able to compress that into a year, able to take all of the rent bumps on the first rent cycle versus having to kind of scale those in over a 3-year period. And so and we're able to maintain that occupancy at such a high level. So really just a positive process, something that we're only able to do, again, because we control the process from end to end and we're fully aligned. So with that, Daniel, I'd love it if you could go to the video and hopefully that'll play for you guys. And if not, the link to YouTube is in the notes.
Sure. So I see the video here. I will put this in the chat bar for anybody who's looking for it. I have had trouble with getting Skype to play the audio of a video, so you may have to go view this for yourselves. You'll see if it works. Are you guys hearing any sound?
Nope.
No. Well,
You're just missing music at this point.
It's a time lapse of that 8-hour process, and yeah, it's just music. It's just it's kind of some upbeat techno. You can imagine it in your head, but you can see the process of. I mean, it's kind of like a coordinated ballet going in and out. You see these guys, and you can see how you can completely change the unit within 8 hours. I just thought that was really cool. I wanted to share that with you guys. it's something that we really developed over a 5-year period, where we actually started with a construction company that we were outsourcing to. We were working with, and we'd had some mixed results, and we decided to bring it all back in house. And as we did that, we were really able to better coordinate to bring the process down and squeeze the number of hours. You'd probably be amazed that of the 8 hours, about an hour and a half of that is waiting for the glue on the floor to dry. So there's some of the operations guys have actually been talking to some industrial products companies about getting a faster drying glue to be able to bring the process down to be even quicker. So I think it's pretty cool what you can do when you get like to that level of sophistication. And we've done over 6,000 turns at this point. So, there's a lot of iterations to get this right. But so Daniel, I don't really have feedback on whether it's the video is kind of through or if we get the gist, but we can move on if folks like to, and it's always available on YouTube if they want to check it out.
Yeah, we've only got about 1 more minute left. If you just want to let it go, I don't know how it's coming through across Skype. It's certainly fast moving on my side, so I'm imagining they're only seeing every 10th frame or so.
Yeah, it's a little choppy, but it's okay. It's viewable.
It's good, yeah.
I was curious if most of the units are pretty similar. Does that help with the efficiency of getting? And then how much time do you spend on pre-work or like measuring and figuring it out up the head of the like buying the materials? I was just curious if you've gotten that down to a system as well.
Yeah, absolutely. So I want to make sure I get all the parts. The first part was how similar are the units, and then the second part was around what's the pre-work going in to set up for that 8 hours.
Yep.
Perfect. Yeah. So it depends. It depends on the property, right? So you said, is it more efficient if they're similar? Absolutely. That makes things a lot easier. So the way that we purchase is in bulk. So, one, it's easier there's cost efficiencies from the economies of scale. But two, yes, if you can do, I guess the easy way to say is we come up with one plan per unit type. So for all the units that are the same, we're doing the same things. And I would recommend that you do that in your own properties because, again, you can buy with scale. And if something breaks, so one of the problems in our single family portfolio is we have 12 houses. There's almost, let's just say 12 different toilets. For example, if one toilet breaks, the one toilet is broken, the maintenance guy's got to go figure out what's going on with that. If you buy 50 toilets that are all the same and you put all the same toilets in, then it's much easier, if you think about that from toilets, light fixtures, et cetera, for the maintenance guys to know what are the things that usually break and exactly how to fix them. So as much as you can buy at scale and as much as you can keep things the same, I would recommend that you do that. From a pre-work standpoint, so we go in and we create a plan for every unit. And this goes back to even the due diligence. So as we're going through due diligence to purchase a property, we walk every unit. I'd also recommend you guys walk every unit. If you're buying a 300 unit apartment, walk 300 units. And in doing that, we inventory to know exactly what needs to be done in each unit. And if we know that we're going to come in and we're going to do a full rehab on each unit, then that's pretty easy. We know we're going to take it down and build it completely back up. But we create the inventory and then we use that to purchase, and we purchase at scale. And because of our size, we go direct to suppliers, and we'll purchase roofing materials and things directly from China, things like that. There's things you can do at scale where you can cut out middlemen, but even going to Menards or somewhere like that and being able to buy with scale is going to save you money. So we buy everything at scale. We have everything purchased ahead of time. I think that's another big benefit of doing it this way, because we've run into situations before where we pick out a cabinet for an apartment And say we go through and we do 20 units and we rehab them, and then we go and want to do 20 units later. Well, the cabinets have been out of stock, and we've had to wait, 2-3 weeks or even longer for the cabinets to come back in. So if you buy everything all at once, you make sure you have everything, so you don't run into things like that can cause delays. So I hope that answers your question.
Yeah, it
Any
did.
other
Thank you.
questions? Yeah, any others? I'm happy to answer questions.
A quick question. So when you buy everything ahead, and you said it takes about a year, so obviously the storage and all those things, warehousing, is that not a big deal?
Not if you have the warehouse space.
Okay.
But I can see as you scale it down, yeah, you've got to, you can only purchase what what you're able to store. So you got to balance the discount of buying the items and buying many of them at a time versus the cost of storage.
Right. The cost of capital plus storage, especially if all units are occupied. If they're not occupied, then of course you can use them as storage, but otherwise they're just curious.
Yeah. Yeah, definitely. Good question.
Hey,
So
go ahead.
I have a question, Kent. Basically, it's a little different question. Question is that you initially was a investor by yourself, and then you have joined with other people and then making it bigger. So like if we have, or if I have properties that I manage, and because a small number of properties or whatever, it's really hard for any kind of renovation, or managing things. So doing personally versus combining them with the bigger institution, what is your comment or suggestion about it?
Sure. So the question is, do you do it on your own independently, or should you partner?
Yes.
Or should you partner with others, or and stay active doing it, or should you invest passively as I started?
Invest passively, yeah, initially. Basically, if I want to grow, what is the best way to grow? Is it the way that I have some properties myself versus consolidate these to other people or other investors and then make it a combined thing and bigger, like the way that you can do right now? It's a lot of you can do renovation at one time. You have in-house everything, right? It's a lot more disciplined and bigger institution than what I have, for example.
Yeah, no, absolutely. So if you want to grow, this is the most effective way to grow in real estate. Real estate is a game of partnerships, and it's also a game of specificity. So if you're trying to do everything yourself, you're not being as effective as you could be, because everyone is good at something, but you're not good at everything, right? So you find partners that have complementary skill sets. For example, some folks, well, let me just give you an example from my residential real estate business. So I have a financial background, and I also have relationships in that space. So that's kind of the role that I play, is financing and strategy around financing. My partner is a general contractor. He had been flipping houses previously on a smaller scale for 12 years, but that's his background. Our other partner, really, he is a former COO, and so he very much runs the back office and the kind of the operations and project management. And so we all have unique skill sets, but bringing them together, we're able to do way more than any of us were individually. So the first thing is, should you do it yourself or should you partner? I think you should partner, with the caution that, you got to look at a business partnership like a marriage. Don't partner after the first date. And other than that, I think as far as the way that you scale quickly, once you have the right team in place, is by finding investors and partnering with investors and working with, so the way that I did it, the reason that I originally went to syndication was because, when I first was like, okay, I'm going to get into real estate, I was like, okay, I'm going to go buy some single families. And then, because I actually went into commercial and then went back into residential. So I did the opposite. I was like, I'm going to go buy some single families. And then I talked to a friend of mine that owned 40 single families. And he's like, oh, I hate my life. I hate managing these. He self-managed them. Every time we would talk, he'd have complaints. I'm like, okay, I don't want to do that. So I learned about apartments. I'm like, okay, apartments, that sounds great. I'm going to go out and buy like a 50-unit apartment. I'm just going to manage that. Well, somebody that was more experienced than me and was a mentor of mine said, okay, after you buy that, what are you going to do? Like, what do you mean? I'm going to run it. He's like, yeah, but all your money's blown. You can't grow from that point. So what are you going to do? I'm like, oh, okay, good point. So it taught me about syndication. It said, look, you can do this with real estate, especially when you're thinking about apartments. Bigger is better for all the reasons of economies of scale and efficiencies and the ability to have better property management, more sophisticated management, dedicated management, things like that. So I said, okay, syndication, this sounds great. I can pool my money with others' money and we can buy something together that's bigger and better than any of us could purchase on our own. So that was how I looked at it. That was my advice. One, partner with complementary skill sets, and two, if you really want to look to scale, you've got to find investors that are going to help you scale, because otherwise the path, there is absolutely a path to building financial freedom one single family at a time. It doesn't take that many if you live, moderately to have the income to live sufficiently on a 10 house portfolio. I mean, it could definitely be done. Probably easier in Indianapolis than it is in California, but it can be done. So there's different paths, but if it's about growth and scale, that's how you do it.
And what is the best way or good way to find investors?
Good way to find investors.
Like people like me who is thinking the same way, looking for investors that they can rely on.
Yeah, I mean, I could tell you how I did it when I came out and how I still do it. I mean, it's so networking, right? So I started with going to every real estate meetup and group that I could find. I put together a pitch deck which talked about my business plan and what I wanted to do. It had a very clear view of why it's the right time, why now's the right time to do it, how I'm going to do it, what I'm going to do, what the returns are going to be. I didn't have a deal that I'd done yet, so I kind of made up an example deal of saying this is what it would look like, so I could have a conversation of, if I brought you something similar to this, would you be interested in that? And I started talking with friends and family first. I mean, I think you're going to raise your first money from friends and family because you don't have a track record. And they're going to invest with you because they trust you and they like you. They're not going to invest in you necessarily because you're a real estate expert at first, right? And then as you evolve, you're going to build a track record and have that expertise. I think another huge thing is you've got to, I'll tell you my biggest lesson learned from the first time that I raised money was, because I raised about a third of what I thought I'd be able to raise, because it's harder than you think. And you've got to position yourself as an expert. You've got to position yourself as a thought leader. And the way you do that is by talking about it and by providing, good content and expertise. And because your friends and family don't view you as someone that they would want to give money to, or just initially, right? Your college friends know you as something, your high school friends know you as something, your parents know you as something, it's none of those, but it's not a professional investor. So you've got to change their point of view, and you do that, I think, by showing off your expertise, by educating yourself first, so you can do that, and then by getting yourself out there. And so for me, I started a meetup in Indianapolis that I host called the Indianapolis Multifamily Investing Meetup. We meet once a month. I'm actually starting a podcast. I've got 4 episodes recorded. It'll launch in May. But those are the things I'm doing now to continue to expand my reach. But that's how you go about raising money.
Hey, Kent, I know when we were talking before the meetings, just as we were getting to know you a little bit, you mentioned also that you did quite a bit of passive investing. And so, I mean, not everybody on this call wants to go through and start their own meetups and really put in that sort of legwork.
Yeah, I mean, we don't have a lot of time because we work for Intel.
Exactly.
So, yeah, that's a very good question. I mean, what would be your suggestion about this passive thing?
Yeah, so I think passive investing is a fantastic way to get into real estate, you know, and still have the ability to do your day job. I mean, like I said, that's how I started. I still invest. I mean, I still have all of my passive investments. I still look at passive investments all the time. I'm pretty selective about it now because I'm putting my money in the deals I'm doing. But I think passive investing is a fantastic way to be in real estate, and you still get all the benefits of being active. So there 100% is the cost benefit of, are the few extra percentage points I'm going to get from doing all that work I just talked about worth it, or should I just invest passively and get my double-digit returns and be happy with that? Because you still get all the tax savings. And you can still get, you know, great returns. So absolutely, I think passive investing is a good way to go. I think in passive investing, you still have to educate yourself. Daniel and I were talking about this. I lost money on one of my first passive investments because I invested with a sponsor who was unethical. And I didn't know that because I didn't know what due diligence was. And I didn't know how to look into a person's background at that point. So I lost money, and it was a kick in the teeth, but it was a great lesson learned. And so, yes, I think, Pat, if you have questions about passive investing or how to do that or how to vet, I'm happy to do that as well.
On a similar note, a quick question. How do you find a good, let's say, if you need to, like a good rent collection company or a eviction company, how do you find a good one?
So if you have a property manager, they do a lot of that, but you're self-managing and you've got tenants that are delinquent.
Yeah.
From an eviction standpoint, you'll want a lawyer. From a collection standpoint, there's bad debt companies out there that will collect bad debt, just like they'll collect bad debt for anything else. I mean, you've got to weigh the pros and cons, right, of doing any of this. Guessing you might be from California, where the eviction laws are difficult. It's a tough position to be in. I don't have an easy answer, but I would say finding an attorney that specializes in that to navigate you through the process is important because there are laws that you do not want to get sideways of. And then someone like an attorney that specializes in that will likely be able to lead you to a collections company.
Thanks.
These are great questions, guys. What other questions do you have?
I have a question, Kent. I was very impressed by your renovations, and I was kind of curious, how did you justify that or get approval for that from your fellow investors in your company?
How do you mean? Approval for which renovations?
The renovations in the YouTube video that you sent us, those must have had kind of a decent upfront cost, correct? Did you raise rents after that, or?
Oh, yeah. Okay, now I understand. Thanks. So, it's all built into the business plan going in, right? So our thesis going in was that by doing these renovations, we can raise rent by X amount, usually $100 to $200, depending on the market and where we're at. But say we're going in and we want to raise rents, we think because of our market analysis, we can raise rent $200 and still be within, median 60th percentile, maybe up to 75th of where rents are in the market. We never want to be at the top. And then to do that, we say, okay, well, what is it going to cost to get us there? By again doing a market analysis, what are the finishes and things that properties that are achieving those rent premiums? I mean, what do they look like? What amenities do they have, and what finishes they have in their properties? And then we put together what that budget is, and then we look at the return on cost, which is, okay, it's going to cost us this much to do all that we need to do to make these nicer. And the return that we're going to get is maybe a $200 rent premium. So we look at a return on cost, and we typically want a return on cost, which is, 20% or greater, meaning that we're going to be able to recoup our investment, over a 5-year period. So that's how you need to look at how you upgrade. Like, I hate when I see people that put granite countertops in. They get excited and they want granite in their unit, but they can't get the rent premium on the other side to justify it. You got to start the other way around. You got to look at the market. What does the market want? What is the premium for doing these things? And then you build your budget around that, and you make sure that you have a rent or a return on cost that you're comfortable with. So we build all that in on the front. We raise our capital expenses up front. So when we do our initial raise, we're raising above and beyond the purchase price to raise money for all of those renovations that need to be done.
All right, thank you.
Hey, Kent. SF has a question relating to passive investing. How would you expect the current nationwide and worldwide pandemic to affect your real estate portfolio in general?
This is good. My disclaimer, I don't have a crystal ball. My personal opinion is that if things do start to open up within the next month, I think it will be a blip for long-term investing, meaning 5+ years. So for our deals that are 5 years out, we've kind of gone back and looked at them and said, okay, what do we think the impact's going to be? Because what we're doing is, so things that we've been doing that will affect the returns. Things that we've been doing are, we're not evicting. We are releasing or renewing tenants at current rent without raising rent right now. We're just trying to focus on occupancy and keep people in there and not hit people with a rent increase, when they're down. And we also are very proactively trying to provide all of the services that we can to them as far as rent relief, helping them fill out unemployment forms, doing all these things. So I think by doing that, and a lot of providers are doing that, but we didn't see much of a rent dip in April, right? I just saw a report from National Multifamily Housing Council that rent was only down about 7% in April from April 1st to April 12th from what it was in March pre-COVID. So we didn't see a big hit in April. The longer this goes, the more of an impact it will have. So I think if it lasts into June, July, then I think you really can start seeing more of an impact long term. But I can tell you, we're planning now not to raise rent for 6 months, and we may not raise rent on our properties for a year, depending on how things go. So for our properties where we've gone in conservatively, we're not expecting much of an impact, maybe 30-40 basis points on the return in 5 years. But for properties that are located in areas that have a lot of hospitality or retail exposure, your Orlandos, your Las Vegas, those are going to be hit harder. And for deals that were predicated on rent growth.
Okay.
Go ahead.
Oh, Kent, I'm sorry. I just noticed the time, and we're actually over time right now. So if you have further questions, I would invite you to either email them directly to Kent or email them to me, and I'll forward them on. Thank you, everybody, for coming, and I apologize for going over time.
Yeah, thanks, everybody. I was going to say, if you show people the last slide, you show them how to get a hold of me if they're interested in
I
it.
actually pasted all of that information into the chat box. And so if you look in your IM window, you should be able to copy it directly out.
Yeah, happy to answer any questions. You guys have had great questions. I appreciate it. Appreciate the engagement. Sorry for the delays.
All right. Thank you very much, Kent.
Thanks, everybody. Have a good one.
Thank you, Kent.